only in this retarded market you can have a stock investment opportunity where on the low end it's a 10x and on the high end it's a 100x. I just saw a press release on Charbone and I about fell off my chair. Okay, I've made videos, I wrote a report on Charbone, and today, this morning, the company came up with an independent valuation for the entire company. And based on where the stock is trading today, the value of the company is, on the conservative side, 10 times the current stock price, and on the high end, about 130 times the stock price. It's unreal. I don't think we will ever see a market like this, the microcap market like this. So I don't think we'll ever see this like this. And people still don't care. They still don't want to look at microcap stocks. So if you're one of those, just skip this video, move on, buy yourself GameStop because GameStop is hot now. Buy yourself Nvidia, because I'm old school. I'm old school. You see, I'm like Warren Buffett. Price is what you pay and value is what you get. So let's take a look at what just happened on Charbone. Charbone just had a press release that the company received independent valuation of US $61 million for the company, for the entire company, confirms significant growth economics for North American green hydrogen production facilities rollout. So I'm just going to go straight into the valuation analysis. So they are saying, this is not my valuation, this is not the company's valuation, this is an independent valuation. And they are saying that the company today, right now, is worth $61 million. Okay? And you want to see what the market cap is? The market cap of Charbone is 7 million Canadian. Now, this valuation is in US dollars. This is Canadian dollars. So if we take this and translate it into US dollars, this is about $5 million US. That's what the market is assigning to CHARBONE Hydrogen Corporation. While an independent valuation says that this company is worth $61 million. And notice what it says here, pre-money and post-money. You know what this means? This means that the company is now shopping around a 5 million raise, whether it's equity or something else, at a valuation of $60 million or $61 million. And you know what this also means? What do you think is going to happen to the stock price when a party comes in and invests $5 million at a $61 million valuation? What do you think is going to happen to the stock price? Think about this. Now, I said that this valuation is conservative. And again, price is what you pay, value is what you get. So I said that at a minimum, you are getting 10 times the value that you are paying. And at a maximum or aggressive valuation or upside valuation, you're getting about more than 100x what you're paying. So what do I mean by this? Well, this valuation, and you can yourself read the press release. I'm just going to talk about the 4 methods of valuation that the company used. Method number 1, market capitalization. Method number 2, book value. Method number 3, market comps. And then method number 4, DCF with terminal value. So discounted cash flow analysis with a terminal value. What does it mean? All the projects, all the green hydrogen projects that Charbone has are put into production. All the costs that it will cost to put it into production versus the profit that the projects produce, discounted all to present, and that is the discounted cash flow analysis. Now, if you go to the press release and you look at how much weight was given to each valuation metric, you can find it here. The independent business valuation was completed utilizing 4 methodologies with associated weight values, including market capitalization. It was given 45% of weight. Book value was given 45% of weight. So in total, those two were given 90%. And then market comparison, so similar companies to Charbone were given how much? 7%. And then discounted cash flow analysis was given 3%. And then the average, or whatever the number came out, was US $61 million. Now, I find it kind of silly to put 45% on market capitalization. In other words, what the market thinks the company is worth. They are putting 45% valuation on it. Book value, which is negative, they're putting another 45% on it. That's silly. And then market comps, which is a much better indication of value. What are companies similar to ours worth? Don't you think that's a much better valuation metric? And of course, the best valuation metric is a discounted cash flow analysis, which was given only 3%, right? But now, even with this conservative and out of reality valuation, we still got 61 million valuation, which is more than 10 times the current market cap, right? Now, which method do you think should be used the most or should be given the most weight? Market cap? What the retail retards think about the company? Absolutely not. Book value? What's on the balance sheet today? Absolutely not. So market comp? Well, that's much better. So market comp. What did they use for market comp? What they use these companies, Hydrogen de France, Monarch Energy, and CHHYF, okay? So if you look at market caps, I was only able to find for the first one and the third one. The market cap for Hydrogen de France, 110 million euros. The market cap for CHHYF, 210 million euros. Right? So between 100 million and 200 million, and what kind of market cap do we have? 7 million Canadian or 5 million US. So based on comparing these two, like a 20 to 40x, yeah? So that's based on market comps. So 20 to 40x based on the market comps, but really, what's really the best method? Well, it's the discounted cash flow analysis, right? And what do we get here? $1.3 billion with a B, right? And now, but here's the trick here. This is a value of the company once all of the projects that they have are put into production. Well, I said in my video number 1 that Charbone has a capital light business model, which means they did all of the groundwork for all of their green hydrogen projects, and then they own 100% of all of them. Now, financiers can come in and put individual projects into production, and they will earn a certain percentage for putting this project into production. Like, for example, maybe 50% if they put the money to put the project into production. So Charbone, as a public company, will retain 50% ownership in a particular project. So if all of the projects were put into production using this method, then this entire $1.3 billion valuation would not belong to Charbone. Maybe half of it would belong to Charbone. So what is half of $1.3 billion? Well, that's $650 million. And if we compare $650 million to what? To today's market cap of $5 million US, that's how we get 130x. So again, price is what you pay, 5 million market cap. Value is what you get. And what do we get? Well, we get a conservative estimate using not so smart valuation method or super conservative valuation method that we get 61 million US. And if we use the proper valuation, we get 650 million. So we get more than 10x of value on the conservative side versus 130x of value on the more realistic, more aggressive valuation method. So again, price is what you pay, value is what you get. That's what Warren Buffett said. So that's why I am invested. That's why I'm covering Charbone. And this press release, I almost fell off my chair seeing these numbers. How much value there is and how much value people don't realize there is to Charbone. So that's it for this video. Make sure you let me know your thoughts. And of course, if you don't like value, make sure you buy yourself some GameStop, some Nvidia, where the price that you pay is much more than the value that you get. Thanks for watching.